Welcome to the Med Favor Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Matt Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. Summer's over. Get back to work. Today, we're joined by Dave Thornton, co-founder and chief customer officer of Vestimate, which helps startup employees unlock the value in their equity. You can go back to episode 447 to hear Dave's first appearance on the show almost 3 years ago. Dave, welcome back.
Good to be back, and that's crazy that it's been 3 years.
First, let's remind people what Vested is, because you're a bit unique. There's not a lot of ideas and strategies out there like what you guys are doing. So maybe explain it first from the employee side and then the investor side, and then we'll dig in.
Noticed a handful of years ago when we were serving startup employees with educational content around their equity that the very long tail of rank and file startup employees tended to not have the money that they needed to exercise their expiring stock options, usually after they had left a company to go wherever they're going next, to Google, another startup, back to business school, et cetera. And although the folks that needed a lot of money were well served, the folks that needed 50 grand a pop were completely ignored by the market. So what we do for the rank and file employees of VC-backed startups is we provide capital to them to help them exercise their expiring options. And in exchange, we usually get a little bit of exposure to the common stock of the private company that they just left. So that's on the employees.
So, for example, let's say someone's at SpaceX. That's not really a startup because it's like, I don't know, 300 billion at this point, but people have heard of that one. Or you got your local AI startup. Someone leaves, and let's say they have, I don't know, 50 grand. Let's do 100 grand just because the math's easier.
Do the easy 100 math. So let's say they have 100,000 stock options with a $1 strike price, and let's pretend that tax doesn't exist so that the math stays very easy. They need 100 grand to do their exercise. And let's say that the current independently produced board approved fair market value of that company's common stock is $3 today. In a case like that, we would buy the minimum number of that person's future shares at $3 a piece necessary to get them the 100 grand for their exercise. So in that case, we would buy 33,000 shares at $3. Our money would go out the door on day one. They would use all 100 grand to do their exercise, and then they would owe us delivery whenever transfer restrictions have lapsed on those shares, the 33,000 that we bought.
What percentage of the shares do you guys take? Is it a ballpark? Is it range?
It totally depends on what the current fair market value of the shares is relative to what their strike price is. The bigger that delta, the fewer shares we need to buy to make the whole thing work. But the example that I just gave you was a 33% example. And if the current fair market value of the company's common stock was $2, it would be 50%. And if it was $4, it would be 25%. So it very much depends.
Talk to us about the percentage and the amount of stock options that go unexercised, because you only have 3 months, right? You got 90 days after you leave usually to be able to exercise. And it is shocking how many people leave this kind of, quote, free money on the table.
It's funny. There's a lot of things to say about this, but one is there is a lot of stock option abandonment. I mean, the most fundamental economic thing working at a startup as an employee is you just don't make the kind of money that you make at Microsoft or at Google or at Meta or whatever. And so the difference is made up in these stock options. But the problem is because you've been under cash count for the 3 years on average that you're going to be there, at this special moment when you leave, when you have 90 days within which you have to exercise your vested stock options, you don't have 50 grand just sitting around for a rainy day, right? Because you were under cash count. So it's kind of a very related vicious cycle. And moreover, I don't think it's a particularly good idea for anybody to be highly concentrated in a single startup. So what you're doing when you're exercising your stock options is you're buying the stock of one VC-backed private company, and they go to zero all the time. And that's kind of not a thing that you should be doing unless you have the wildest amount of conviction or a lot of discretionary cash. So using other people's money is what you should do, and people should abandon way less if they can.
I saw a stat where it says it's roughly half go unexercised. And you guys talk about in the hundreds of billions of dollars over the course of a full business cycle. That is an astonishing amount to me. Like, who wins in that scenario? The company? Are the companies kind of not encouraging this because they're like, whatever, you're gone. See you later. Peace out. We don't care if you do this or not.
We actually got a lot of early reps at interacting with the founding team of companies 3 and 4 years ago when we started off putting together the portfolios that we put together. And I never picked up on anybody trying to screw their employees out of shares. The sense that I got was that the reason that this problem didn't have an obvious solution is because when you're a startup, your first job is to not go out of business, and your second job is to grow revenues, and your third job is to get profitable. And then like number 26 is facilitate post-termination stock option exercise for a subset of your employees. It's just kind of logistically complicated. So on the who wins question, I guess technically all of the existing shareholders of the business win when startup employees don't exercise their options. But the reality is that in any one company, we're talking like a point or two of the cap table max. It's just not enough for that to be anybody's primary motivation.
It's like a breakup. Wouldn't you want a bunch of ex-girlfriends that like you are saying, you know what, we had a great breakup. We're still friends. We're cheering for you. Same thing with companies where I was like, it's a de minimis amount. They shouldn't care, but like they should help those people. Like, look, you worked here. We gave you some equity. We want you to be out in the world saying, you know what, this company, I'm not going to flame them on Glassdoor. I want them to think of us in a wonderful, loving way. It seems like they would want to smooth that transition, but I guess it's like an incentives problem. It's like not a huge focus.
It's just a not enough hours in the day problem, but I so deeply agree with what you just said. It takes very, 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 very little to support your employees a little bit. Having a liquidity provider for stock option exercise after you leave, doing a periodic, not often tender for like 5 to 10% of your shares as a current employee, like the recruiting and the retention benefits that you get by being one of the companies that does that for your employees versus everybody else who doesn't are massive. It really doesn't take as much effort as people think it does, and they really should do that more often.
While we're here, so one of the big challenges, of course, is what's the damn thing worth? And so SpaceX is a little easier because there's kind of a market in those shares, but for something that's 10, 20, 50, 100 million market cap, and also just by whatever's going on in the world, you just lick your finger and put it out in the wind. Like, how do you guys slap a valuation on it? And do you kind of decide the valuation and tell the employee, or how does that work? Does the company set it?
Yeah, typically what we do, and because we serve such a broad set of companies, and because if you're doing traditional venture type diligence, you're meeting management teams and you're trying to read people's souls and you're getting their decks and you're getting their financial models. Like, if you want to serve a very broad set of companies, that level of effort is not even on the table. So the one price that exists for every venture-backed company's common stock, which is the stuff that the employees get the opportunity to buy, is what's called the fair market value of the company's common stock. It's produced a minimum of once a year by a third-party independent valuation firm. It's approved by the board, and relevantly to the portfolios that we put together, it has embedded within its construction a discount for lack of marketability, mostly because common stock is not marketable in a private company outside of shops like SpaceX and OpenAI and whatever. And even then, not so much. So we usually buy shares at the extant third-party produced, board-approved fair market value. And we're usually okay buying at that price because we know that we're putting together a portfolio that we actually intend to hold. And so the ability to market it and the discount that comes with that is not as big a deal for us.
All right. So you guys see 30,000 opportunities. That's a lot.
Well, 30,000 companies that are VC backed and US headquartered and have some employees that at some point are going to leave for whatever their next thing is. But you're right. We can't support them all. So let me kind of draw the polls. On the one hand, there's supporting every employee from every VC-backed company. On the other hand, there is the 50 to 100 companies that are super late stage, whose names everybody know, that's the SpaceXs and the OpenAIs of the world, that actually have a decent secondary market that exists and a decent amount of liquidity. We're kind of in the 3,000 range of companies that we're okay with, and that you can think of that as the top 10 or maybe top 20% of venture-backed companies. The way that we come up with our opinions is we have an internal selection model that basically predicts how much growth is left in the company's common stock. And it's powered by a bunch of like fairly proprietary data exhaust that we get in running this business where we interact with thousands and thousands of startup employees. And I'll give you a couple examples of the type of data exhaust. But the bottom line is if you give the model credit for doing a good job creating a relative ranking of companies, we look for the top 10 to 20% of companies, which is a few thousand. And that's a significantly bigger catchment area of employees that we can help than the employees that belong to the 50 to 100 companies that actually have proper secondary markets.
Well, let's hear a little bit about it to the extent you're willing to share. You've told me this in passing, but I'm not sure how much we'll be able to make it out of the secret safe under lock and key about novel data sources. Talk to us a little bit about, on a broad level, some of the ideas you guys use to whittle this down.
Okay, so we start with a bunch of table stakes data that you'd expect anybody that was taking a quantitative approach to the venture asset class to have. So like companies' financing trajectories and the terms on which the financings were done and the investors who are participating and whether the investors continue to participate in every round. There's some macro data that you'd expect to be in there, like how are public equities doing and how are rates doing. There's a bunch of signal around how employees are moving to and from companies, which is the company hires their first CFO. That's the best sign ever. If they quietly lay off 60% of their people, that's the worst. We've got some financial performance estimates.
But it creates a lot of supply. So it's like, you're like, why is there 30 salespeople all wanting to sell us their restricted stock?
Actually, you want to hear something funny? Proportion of quota carrying sales reps is like a very predictive thing for how well a company is doing. So yes, when 30 salespeople show up at our front door, that's as bad as it gets. But those are kind of not the proprietary data sets. The most interesting data that we collect is from observing the thousands of employees that are running around our website and interacting with us on LinkedIn and over email. And just to give you a sense of what I'm talking about, sometimes an employee, and actually this happened just this morning. So I saw this in my LinkedIn, so it's topical. There's an employee that told us this morning that he intends to forfeit 100% of his options. He wouldn't even exercise them with other people's money, which is the most negative signal that you could possibly pick up from somebody that you're offering a free option, right? On the flip side, sometimes we see people, when we reach out to them, say, I've been early exercising with my own personal capital at every available opportunity. So I actually own all my shares. I don't need your help. And that is as good as it could get because they're taking their own risk and they've taken it at every opportunity available to them. We also see things that show up on our website. So like behavior when employees are coming through our transactional flow. Sometimes they counter on price, which shows a lot of belief in the company. And sometimes they, instead of selling the minimum number of shares necessary to support their option exercise so that they can own the maximum remaining number of shares, sometimes they try to sell all of them. And in any one case, it's not dispositive because like somebody might need money in their life for regular reasons. But if you look at all these things as a mosaic, it actually has a ton of signal in how companies are doing. That's the most interesting stuff underneath our selection model.
So another thing is you kind of solicited some professors, ex-professors, dig in some data, some public filings. Can you talk about that at all, or at least give us a little peek?
Yeah, sure. So another one of the quasi-differentiated data sets that we use, which is not the most proprietary because it's not derived from like the employees that are users and the broad base of them, but it is pretty interesting, is a data set that is built primarily on tax and labor filings that are made at the state and municipal level, from which you can do a reasonable job attempting to estimate a company's financial performance. And what we've seen in the world of VC-backed startups is that this particular data set is never on the nose accurate, and it's sometimes inaccurate in both directions, which is to say it's not that easy to like adjust for. But the signal that we find in the data set is not its accuracy today, because we're not trying to build the analytic models that I already said that we didn't have time to build. The interesting part of the data set is that it's consistently inaccurate for the same company. So if revenue estimates are going up for that company, that's interesting. Like the growth trajectory is interesting.
Reminds me of the old earnings revisions screens for stocks. That was always a big signal for a long time. A lot of this kind of the wedge in the analytics, and even there's some soft analytics. You know, you're talking on the phone with a startup employee and they're like, look, this company is crushing it. I just had to leave because of XYZ or whatever. And I would do anything to invest in this company. Like that's insight you get that's squishy. That in private markets is okay. In public markets, if the CEO is like, look, this company is crushing it, I can't tell anyone, but NVIDIA is going to destroy earnings this week. That would be insider trading. But on private markets, they're private. There is no public information.
The good news for us as it relates to that kind of thing is that the rank and file startup employees that we're primarily serving, they don't tend to see the top level levers of the business. They don't tend to have visibility in the kind of things that could get them in any trouble. So they do have opinions like this company is absolutely killing it. I'll give you another example of like a squishy signal that we take very seriously. Sometimes people are terminated for reasons that are nothing to do with the company trying to retrench and lower its cost base, right? And when an employee is terminated as opposed to voluntarily leaves and still wants to exercise their options despite all the feelings that being terminated might stoke up in somebody, that's an incredible signal too.
So the takeaway, listeners, from all this is that presumably Vested is acquiring shares at a discount. Is that fair to say?
Yeah, we're acquiring exposure to the common stock of the top 10 to 20% of VC-backed private companies at a price that includes a discount for lack of marketability, which is not that big a deal if you're going to be in a buy and hold position.
So walk us forward. It's been 3 years. You guys have raised a handful of funds. Maybe give us an overview of kind of from the investor side, what you guys offer as far as these funds, why that's compelling, and we can dig into a little more after that.
So let's see. We've now raised and fully deployed 5 funds. We've raised somewhere between 60 and 65 million in terms of total capital into the funds. The next fund that we're going to raise is going to be our first 9-figure fund, which we're going to try to do a first close in the fourth quarter and then march forward from there. And this is kind of the scaling phase of our business that we're initiating now.
So talk to us a bit about the funds. Like, what's a standard fund look like? So you're kind of doing these maybe once a year historically on the vintages. How many names does it own? What's it look like as far as stage and sectors, all that good stuff?
Yeah. So in our historical funds, we've had an average of like 200 to 250 positions, not all of which are unique companies. Sometimes we'll get an employee from company A and then they'll refer a friend from company A later. So probably like 170, 180 unique companies. And they actually look and feel like the venture asset class as a whole from a sector perspective. So like little over half tech, meaningful sleeves of healthcare, B2B, B2C. From a stage perspective, they're a little bit more uniform. So from Series A through Series, what we call F+, which is just another way to say super late stage companies, it's pretty uniform with a little bit of underweight in Series A companies, because that's your first scaling round and proportionally fewer people are leaving specifically after an A, and a little bit underweight in the Series F+ companies, because those are the companies that have proper secondary markets, and so there's meaningful competition for those deals. And then most of the math is in B, C, D, and E.
What's the exit? Is only IPO? Are you guys ever looking to do secondaries? How do you get rid of these positions?
We actually have a really interesting set of liquidity paths. So yes, corporate events are a liquidity path for our positions the same way they are for any traditional VC. So if there's any sort of a public listing, that's an exit. If there's any sort of an acquisition, that's an exit too. But also because our deals tend to be done directly with the startup employee, and I can talk at length about why companies actually prefer us to be working directly with their employees as opposed to with and through the companies. It goes back to the this is all logistically difficult comment from earlier. Whenever our counterparty, the startup employee, gets the opportunity to sell their shares, that's also a liquidity event for us. So in addition to the corporate level liquidity, there's the individual level liquidity. And to give you kind of an example of what that could mean, sometimes companies will raise an oversubscribed round where all the investors had their allocations cut back a little bit just to make room. And usually on the back of a round for a company like that, where there's plenty of investor demand, the cutback investors will go to the management team after the round is done and say hey, we all wanted to own 5%, but we only own 4%. Can you maybe let us buy some of the employee stock? And they'll put together what's called a company sponsored tender. And that's an opportunity for an individual employee to sell some shares, usually at the price of the round, which is a phenomenal price to sell common stock. So that's an example of an extra type of liquidity event that we get. Another example is if your company makes it to be a late enough stage company that there's now a proper secondary market for it, if you walk over to one of the secondary markets and sell your whole block, that will also be a liquidity event for us. So there's two paths to liquidity, corporate level and then individual selling.
What has most of it been to date for these funds? I mean, they haven't been around that long, so maybe I'm assuming it's a fraction of companies have had liquidity other than bankruptcy. What is it traditionally? Is it the secondary or is it mostly IPO or what?
Liquidity events, which means I will stick to the good ones.
Yeah.
So it's way, way, way more acquisitions than IPOs, which is true even in a normal market. So it's been especially true in the last 2.5, 3 years. But a very meaningful portion of the individual liquidity events relative to the corporate events. So quite a few secondary sales and company-sponsored tender sales after oversubscribed rounds. I would say off the cuff, and I may have to self-edit this later, but probably 25% of individual liquidity events versus 75% corporate events.
I keep waiting for the IPO window to just come smashing open. You'll see these big companies IPO and it be a big pop, and you think, okay, all of a sudden you're going to see these 10, 20, 50 that have just been waiting come to market, and it just hasn't materialized yet. And the market's at all-time highs. If they're not going to now, I don't what are they waiting on, Dave? What's the deal?
It's hard to really guess. I mean, I know that there's just some basic fundamental constraints about how many new deals can possibly come out and be roadshowed by the banks that are doing the underwriting. So there's a huge backlog of probably over 1,000 companies that could conceivably be public that will just not be this year because there's not enough time in the day. However, I think there's probably also a decent amount of uncertainty around what the economy is actually going to look like in a few months or 6 months or 9 months. And I don't think we're out of wondering that collectively, which could slow things down.
So who can invest in this? Is this accredited, qualified? Is it individuals and institutions?
Anybody who is an accredited investor who's also a qualified client, which is kind of like a sub-denomination, can invest in the funds that we're going to be raising.
So let me ask you, when you think about venture and you think about getting exposure, there's a handful of ways to do it. You can go buy a bunch of VC funds. You can buy a fund of funds, which, in most VC funds, you're going to get 10 names, 20?
Yeah.
Usually
10, 15, 20 is pretty average.
10, 20. So the downside of that is you got to go research diligence and get a whole bunch of them. Or you could do a fund of funds, which adds a whole nother layer of fees for all of a sudden you're not at 2 and 20, you're at, 3 and 30 or 4 and 40, who knows what. But it solves the diversification problem. So if you're someone that's look, I want this asset class, boom, shotgun. One of the nice things you guys do is, and we talked a little bit about this in the last podcast, but maybe you can kind of update any learnings, any thoughts on this, is you're getting a lot more names in your funds than a standard VC. So do you see this as sort of like a fund-to-fund exposure type of investment? How do you discuss the narrative and market this when you're talking to people?
Yeah, it's a little bit hard to get it exactly right because although we are very diversified and very unconcentrated, it's not quite right to call it us an index because we're focused on the top 20% of companies. So maybe you could think of it as like a very factor weighted index or smart beta with a little bit of alpha from the embedded purchase discounts. But as far as how I think about the product, it's like fund of funds exposure, except a single layer of fees. So although 2 and 20 can sound expensive, it's definitely not 3 and 30, which is a very meaningful difference. And on the flip side, you could go and source a bunch of individual venture managers and invest in, 10 or 15 funds, each of which has 10 or 15 holdings in it. The only problem is nobody's got the time to do that. So like big endowments have 10-person teams that can go constantly source and diligence venture managers and nobody else does. So I don't think it's particularly actionable for even most institutions. I think it's an especially interesting value proposition to the high net worths that have historically been locked out of the asset class and their money is managed by a financial advisor. That advisor has a lot of constraints on their time and their wherewithal to diligence a bunch of fund managers. So I think mostly it's an access play with attractive fees relative to the fund to fund option.
How long is the subscription period? Is it 10, 20 years like most VCs now?
No, it's the next fund is very, very likely to end up being a 10-year fund, which is a fairly standard term for a VC asset class type fund, but we don't expect it to go further than that. When you put on a lot of positions, you end up getting random liquidity, and we're not reinvesting the liquidity. The intention is to distribute it immediately.
Talk to me a little bit more about kind of learnings, developments over the past 3 years. Now, this could be vested related. You could talk about your Vestimate. It could be VC market related. We can get into both. Either way, fork in the road. Pick it.
Yeah, there have been a few different business level learnings that we've had over the last few years since we last spoke that have been pretty worthwhile. So one is right now, we do our customer acquisition directly. We actually pay attention to people and their LinkedIn profiles, and we see when they put an end date on a LinkedIn profile that, that belongs to a company that we're interested in, and we'll reach out to them directly. And we are, I don't mean to publicly pat ourselves on the back. We're phenomenal at customer acquisition. It's not because we're so good at it. It's because we're solving a very acute problem. But at the same time, 50% of people don't update their LinkedIn profiles until well after 3 months when they found a new job. So one of the learnings that we've had, and this is a learning that we're baking into our scaling story over the next few years, is we should really give people a reason to know us ahead of time. And so one of the products that we're launching now is not around stock option exercise funding, but rather tracking the value of your equity over time. As a current startup employee who doesn't need money and they just want to know, how's that part of my comp doing? So we've soft launched a product called the Vestimate that basically estimates the fair market value of a company's common stock and shows it over time and shows it compared to a competitive set, which should be a useful tool for startup employees who are kind of happy at work right now and paying attention to their equity.
That's really smart. How do people find that? They go to just Vested and...
Yeah, they head to vested.co, and we've built kind of a bifurcation in our website flow. If you need money, go left. If you're just here to pay attention to your equity, go right. And if you go right, you can link your Carta account. We're a partner of Carta's, which will help validate that you actually own the stock that we are going to help you estimate the value of. And then you can see all the cool fun graphs associated with any of the companies that you actually own equity in.
I like you use Pied Piper as an example. If any listeners know that reference. You know what's interesting about this? This is an interesting wedge because it brings people in for education. It also kind of condenses this concept. Who did a really good job of this was Riskalyze, where for financial advisors, they were able to condense your quote risk score into, hey, I'm talking to a client. We're going to give you a score for how much kind of volatility you can target, and here's what your portfolio should be. A lot of inputs onto this, and a lot of people would have some criticisms about that, just putting into a score. But regardless, it was a huge lead gen as well as product market fit from the advisor to the client that this company built. They then, for some unknown reason, changed their name to Nitrogen Wealth. which I think is like you had such a great brand. Why would you do that anyway? Love our Riskalyze friends, but it's like watching Cracker Barrel, which I think is already reversed. Like Twitter's another one, Elon. So this is a cool idea, Vestimate, where people say, okay, I can start to understand this is an asset that I probably shouldn't just let go away, but it's a cool way to get people into the fold.
Yeah, and we're already seeing some interesting effects. I think the sample is large enough for what I'm about to describe to you to be fairly conclusive, but the stock option abandonment rate right now, as opposed to a few years ago when it was like 50%, now it's like 70 and change percent. But for the folks that have come and checked out the Vestimate and basically made the decision that they are a person who cares about this asset and should try to, pay attention to it over time, they're abandoning at decently lower rates. The last number that we saw was closer to 55%, which is a big difference from 70%. That's a lot of money that you're not giving back and that you're holding on to the upside of. So I think there's value there. And you're right, from a customer acquisition perspective, the idea is that if we can provide value to you a long time before you need our money, we're probably going to be your first call when it's money time.
I wonder how much of this you could even do some public facing, because I imagine the amount of searches for XYZ stock valuation. So where all these databases that track this, but at least coming up with some visuals for people. I mean, there's a long tail of, like you said, 30,000 companies. Might be an idea for, I don't know how easy that would be to publish front facing, but I imagine that's a consistent search for a lot of people.
For sure is. And it's relatively easy for us to do the data work. It's a little bit harder to figure out how to make it public facing in a way that will be valuable to constituency A and not annoying to constituency B. I think the right level which to publish that kind of data is in baskets. So like talk about how the fintech sector is doing, talk about how Series B companies are doing. Don't talk about how an individual company is doing. Unless you specifically own equity in that individual company, and then then you can sign up and verify that you own the equity, and then we're happy to show you how that company's equity is doing.
Because I feel like so many people, including the employees, the challenge is just like they're coming from a place of lack of certainty and information, and this solves some of those issues. I like it. What else should we talk about that I'm missing here? Fun side, what's been going on the last few years, learnings, AI, the public adoption of these type of strategies. We've seen a bunch on investor access to alts, some good, some bad.
I love that topic. I don't think we're anywhere close to done on that topic, but we've seen some different structures start to enter the investing world to make alts more accessible to folks that have not previously had access. I go back and forth on the interval fund and tender offer fund concept, where there's a little bit of liquidity baked in and it's a little bit more publicly accessible. I also like the idea of a closed-end fund trading on a listed exchange, although the only public comp that exists for that in the last year was the Destiny Tech 100, which is it's hard not to have extremely mixed feelings about. But it is kind of cool to still.
What are the positive feelings? Just kidding. It can't be mixed feelings. It's just all negative feelings. Just kidding.
Access and liquidity. It's, you want to support folks that are providing both access and liquidity, but a fund trading at 20x its NAV is just a deeply bad thing. So
I feel like AI is sucking so much air out of the collective room. I wonder, like when I look at my angel investments, we're getting ready to be across 400 now. And I'm particularly interested in the ones that are not AI, because I feel like they're the sort of orphan child that's not getting the attention, or, someone that might be doing really cool stuff that just doesn't have AI slapped on their name. Are you seeing any of that? Is that something that's interesting? Is money flowing again to this world?
It seems like it's flowing very heavily in the direction of companies that are doing proper large language model, either development or picks and shovels around that world. And it seems like it's slowed down to a much more reasonable pace relative to 2020 and 2021 in every other part of the world. I guess the small bit of good news is that a lot of the companies that overcapitalized and kind of assumed they had to grow into their valuations from 2021 have now kind of washed out of the asset class. So like the funding that's going into companies now is going primarily into companies that are doing pretty well. which is a good thing.
Let's look out to the future. It's 2025. You come back on the show in 3 years' time. Hopefully it's not that long, but it might be. What are you guys thinking about? Is it kind of just blocking, tacking, executing, launching funds? Are there some ideas you guys are working on that are particularly excited about? What's the future hold for Dave and crew?
I hope that a few years from now, we will have made one of the major employee and company facing scaling jumps. So to give you a little bit of history, the reason that we work directly with employees rather than kind of with and through the companies is because when an employee wants to do a stock option exercise and they need to sell like $50,000 worth of shares, you could get the company involved by asking them to retitle the shares, except companies don't know how to do that, and they don't want to run a right of first refusal process, and they don't want to do board consents and all this other like really annoying stuff that is just never a company's first priority. And so as a result, we serve this very large market of usually ex-employees kind of on a direct-to-consumer basis. But if we do a good job on the capital raising side and we start to run progressively bigger funds, which is what's starting right now, at some point we might run into a company where we're serving their ex-employees in such a way that like instead of $50,000 times 3 in a given year, we've got like $2 million of that company's stock that we're transacting in. And at that point, you really, really want to be working with and through the companies, and they would want that too. And so one of the things I'm really hoping everybody starts getting over the next couple years, because this will massively facilitate the transition from working directly with employees to working with and through companies, is companies taking the employee recruiting and retention benefits around providing liquidity to their employees much more seriously. So we see a lot of forward-thinking CFOs come inbound to us and ask us if we would run a liquidity program for them, but that's a very self-selected group of people. So if like 50 of those came in last year, that's probably just the most forward-thinking 50 companies. My hope is that across a few thousand companies, the companies pick up their heads and realize that helping employees treat their equity comp as more than a paper lottery ticket is a very valuable thing for the company itself.
I wonder if going through the VCs too, is that something that would be a beneficial wedge where you like reach out to A16Z and it's like, yo, you should tell these companies that they should offer this to their employees, or are they just too busy doing other stuff?
I think everybody's a little bit too busy. It's almost a collective action problem. The company doesn't quite have the time to do this stuff. A16Z has a great investment business and they're constantly going out there and doing primary rounds. And this would be kind of like a new muscle for them to develop. Not that they couldn't, but my sense is that any of the folks that are best positioned to solve this problem, it's probably like their 14th priority. So the hope is that the companies at least recognize the value of solving the problem. And then folks like us can kind of step in to be the plumbing providers.
Where do you think you guys hit a capacity? If someone waved a wand, CalPERS listened to this and they said, oh, damn, Dave, you guys are doing some cool stuff. We're going to give you a blank check. Like, how much could you guys actually put to work, do you think?
I think that it is a low single-digit billions number fairly easily. That's just how big the extremely long tail of rank and file startup employees that are abandoning their options is. So if you are sufficiently tech enabled to be able to serve that long tail without falling over operationally, you could put single digit billions to work in a given year.
Hey, let's make it happen. I like that. Well, cool, man. If people, either employees, investors, want to talk to y'all, what's the best place to go?
Yeah, employees should go straight to the website, which is an employee-facing website that's vested.co. And investors should find our main email, which is investors@vested.co, and tell us they're interested in the next fund, and we'd be happy to talk to them.
Dave, it's been a blast. Let's do it quicker next time. Thanks for joining us today.
Yeah, thanks a lot, Matt. I appreciate it.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.